In this video, I'm going to walk you through 12 financial tips in a home sale regarding lending with the help of loan officer and branch manager TJ Roberts. If you're new here, I'm Realtor Pat Kapowich. Housing issues with Pat, dressing up transactions in more ways than one. So let's get into it. Oh boy, we have a great show today. One of my all-time favorite loan originators, branch manager, TJ Roberts. TJ, welcome to the program.
Thank you so much, Patrick. I'm happy to be here.
I've heard you speak many times on Zoom calls with real estate brokers and agents throughout Silicon Valley. Of course, this show could be heard nationwide, so we want to keep it broad. For instance, you were speaking about in an environment where interest rates are going up, you may not use an adjustable rate mortgage.
Or you may not use a fixed rate mortgage. You can actually use an adjustable rate mortgage if there's a benefit to it. Oftentimes when interest rates go up, you're going to see that the adjustable rate mortgage, which is a shorter term fixed rate mortgage, will be a little bit lower for your consumers.
You had mentioned about Fannie and Freddie versus portfolio lenders. So you were blending why one might not use an adjustable rate mortgage.
You actually have three different types of lenders out there. You have the banks who lend according to their guidelines and their specs. And then you have mortgage bankers who can do banking as well as brokering, which gives you the option of product lines that they may not have. And then you have mortgage brokers, and mortgage brokers can broker to all of the above. So you have all three that will do different types of lending based on what they want to achieve.
The portfolio lender, meaning they loan their own money and they hold on to the loan for the life of the loan or as long as they want it?
Correct. Oftentimes a portfolio lender could be a credit union, can be just a regional bank, can be a national bank, and they'll write their own guidelines not to fit into the FHFA or Fannie or Freddie as we refer to them.
I remember in the 90s, I was representing a lot of buyers and I negotiated seller concessions.
Seller concessions is a very important thing to know when we're seeing markets where interest rates are rising. And especially if there's a market where they're trying to curb inflation and they're raising interest rates for that type of thing, then you'll oftentimes see that the seller will give a contribution to get the buyer a lower rate. Now they can do what's called a permanent buy down, which means they pay extra points for the consumer or the buyer permanently to buy their interest rate down for either the adjustable rate mortgage, fixed rate term, say it's fixed for 5 years and then it adjusts, or for a 30-year fixed mortgage, which is more typical.
So points, let's speak about that for the layperson or the seller who has not been in the market for a while. 1 point, that's prepaid interest?
So any points that are paid, and they can pay up to 6% of your purchase price in contributions for a loan that you put 5% down or more, and 3% on loans that have less than that, except for on investment properties. Those are capped at 4%, meaning 4% of the sales price can be given to the consumer or the buyer in contribution to closing costs, including points. Points are in a relationship like a seesaw. The higher the points, the lower the rate. Higher the rate, the lower the points.
When I was representing a lot of first-time buyers, I would ask the seller to pay some points, some prepaid interest for the buyer to lower their interest rate so they could get their foot in the door. What's the terminology used in lending?
The lending side, we do call them seller contributions to closing costs. You need to be very specific as a real estate agent to make sure that you say all closing costs, that you don't say just non-recurring closing costs. That means that you can actually, as the seller's contribution to help the buyer get in, they're able to actually pay everything, including their impound account, paying down the interest rate, setting up all of the fees that go along with title and escrow, all of the things that happen in the transaction, either one time or recurring, and they're able to do that through their contribution.
Excellent point, because when we have a home sale, for the lay people out there, or individuals who have not bought and sold for a while. The neutral third party is the escrow holder, and there is closing costs associated with each side of the transaction.
That's
And
right. They're in two categories. They're considered recurring, meaning you're setting up a savings account for the buyer to have their taxes and insurance and prepaids for interest paid. And there's also non-recurring. Those are one-time costs like a transfer tax for the property or title or escrow fees, loan fees, and points. Those would all be in those categories. It's important that you delineate the two because as a real estate agent, if you write a contract for just non-recurring, that means that 6 months of prepaid taxes, which can be very hefty in some states, is money that the buyer has to come in with, which limits your buyer pool. In a raising interest rate market, you tend to see seller contributions, often called concessions, but they're really contributions to help get the property sold. So that money that they contribute comes out of their proceeds and is done at close. So if you compare it to dropping your price, even though your price is valid and is supported, you're actually able to net more funds to the seller and have a bigger buyer pool than just lowering your price.
excellent point. And you have spoken about that on Realtor Zoom meetings. Now, depending on where we are in the country, for instance, we were on a Zoom call this morning and a real estate agent talked about selling a property after a $200,000 price reduction. So now nationwide, typically we have 1/3 of the homes will experience a price reduction before they ratify a purchase contract. For instance, if you're in a rural area, the average home price is $450,000 versus $1 million or $1.5 million. Rather than do a price reduction of $50,000, $100,000, or even $25,000, the seller could cut that number in half and offer $12,500 for seller contributions.
Absolutely. And it's a good opportunity when you have interest rates rising. You can do what's known as a permanent interest rate buydown. And you can also do what's known as a temporary interest rate buydown, helping the buyers ease into maybe higher rates because maybe they've been shopping for a while and the rates have just ticked up. And now they're looking at their payment while they're fully qualified. They're looking at that payment and they're thinking, I don't know, this is a little scary. Easing them into it by having an interest rate 2% lower the first year and 1% lower the second year. And then at the 30-year fixed rate, you're going to be sitting at the note rate is really a good way to ease them in. And if you're looking at a loan that's say $700,000, because that's our new conforming limit range, if you're looking at a loan of $700,000, you're talking about having their payment be about $1,100 less a month for that first year. Now, how that is done is the prepaid interest, the 2% lower for 12 months and the 1% lower for 12 months, is paid by the seller's contribution to closing costs, also known as points. It's bought down temporarily where they do have a little bit higher note rate, but they're at the market rate for the note, and they just have that ease of payments for the first 2 years.
We have an adjustable rate loan, and then we have buy down loans, which I've heard you speak about.
Yes, so the buy down loans are available on both adjustable and fixed. So when you're doing an adjustable rate mortgage, the current market has adjustable rate mortgages that are fixed for a certain term. That term that they're fixed for can range from 3, 5, 7, and 10 years. You will buy down the fixed rate of the adjustable rate mortgage for a period of time. There are two types of temporary buy downs. You have compressed, which means it's every 6 months, and you have annual, which means it's every year. Now, those are available for both the fixed and for adjustable rate mortgages or ARMs.
Depending on the buyer, they all have different wants and needs in terms of their qualifications, the property, the size of the mortgage. And that's where a skilled loan originator like yourself will listen to all the parts before you submit that loan application.
You really want to hit all of the things that are important. When a buyer comes to me, I fully educate them on the costs and benefit of owning a home. I'll show them things that maybe other lenders won't, like transfer taxes, the notary fees, things that we know as commonplace as being in the industry, but they may not know as a first-time home buyer. Government loans, and as low as 3.5% down for government loans for FHA, or zero down for VA. All of those product lines will go through and see what suits them for their payments and
Okay,
affordability.
VA, that's a Veterans Administration.
Yes.
Buyers have different wants and needs, and that's why I have my different Rubik's Cubes here. And I know that an originator like yourself has to look at their loan application, their wants and needs, and based on, what is it, government type loans versus portfolio type loans.
And don't forget conventional.
Conventional and jumbo. So we have a lot of terminology here.
I define those four categories for you. A conventional loan is often referred to as a Fannie or Freddie loan, or referred to as owned by the FHFA, who override or the run of Fannie and Freddie.
Okay, so nicknames, what is a Fannie versus a Freddie? What's the full name?
Fannie is actually Fannie Mae, and the other one is Freddie Mac, and they are two sister companies that are quasi-government companies at this time that are being run for the secondary market. That's where you talk about mortgage-backed securities. That's what they do. They don't actually originate loans. Those loans are originated by loan originators at banks, mortgage brokerages, credit unions, etc.
Okay.
So that would be your typical conventional loan. Then a jumbo loan, that's actually an investor pool or a banking product that is offered out to the community for loan amounts that are over the limits of a conventional loan. And they set their own rules, and each one is a little bit different, and they have different underwriting criteria. When you're working with a portfolio loan, it's very similar to a jumbo loan. They make their own rules based on the appetite that the bank has, and they tend to service that loan. Government's a whole nother world. When you're dealing with government loans, those government guidelines are designed by HUD. So you have your Veterans Home Loan Benefit. I try not to call it a loan. It's really a benefit for serving our country. And as a military specialist in home loans, I love helping a veteran get a home. On FHA, that's the low down payment version of the government loan, where you can put down as little as 3.5%.
Hey, could you please explain the difference between HUD and FHA?
Well, HUD is Housing and Urban Development. They're the ones who designed the program. FHA is the Federal Home Loan Administration. They're the ones who administer the program and the guidelines. Neither of those entities originate loans. They are actually just the guidelines behind it for us to be able to do low down payment financing.
These terms, conventional and jumbo, can you explain the difference?
Yeah, conventional is often considered conforming, and they are your Fannie Mae and your Freddie Mac loans, the ones we talked about a little bit earlier. And they can be fixed, they can be adjustable, they can have buy downs, they can have all sorts of different caveats to them. And guidelines are from actually the FHFA, who is currently presiding over Fannie and Freddie. When you're looking at a jumbo loan, those loans are often either backed by an insurance company or backed by a bank. Those guidelines are specific to the appetite of that bank or that insurance company. Sometimes they can be a REIT, but that's fairly rare. Those guidelines are going to be a lot more specific to each product, whereas the Fannie and Freddie guidelines are going to be very standard. So that's what makes it a lot more competitive to be able to do a conventional loan. And in some states, you can have a high balance conventional loan or high balance conforming loan, and you can reach up to a lot higher, almost $1 million in your loan amount.
The name jumbo indicates that's a larger loan amount.
Absolutely. The jumbo definitely is a larger loan amount. However, a lot of the jumbo investors or jumbo product line only required to be over the conventional maximum loan. So it doesn't have to be $2 million. It doesn't have to be $3 million to think jumbo. It could be as little as $700,000.
Let's talk about private mortgage insurance or mortgage insurance, MI. What is that all about?
I'm so glad you asked because I have been approached by a lot of realtors regarding PMI and MMI. They are two different things. Let me go into MMI first. MMI, or monthly mortgage insurance, is what you have on a HUD loan or on an FHA loan that we spoke about earlier. These government loans have monthly mortgage insurance and it's very expensive. They also have what's known as upfront mortgage insurance premium that is actually financed into your loan. So when you're doing a 3.5% down loan, you actually have another 1.75 added to your loan to do a low down payment loan. So your principal balance is higher. On top of that, you have monthly mortgage insurance premiums that range from 0.80, that's a factor against your loan amount, to 1.05 per month. The disadvantage of this type of product is that the MMI doesn't go away, whereas the PMI does. So let me tell you about private mortgage insurance. I have so many realtors who say private mortgage insurance, oh, that's a penalty. I have consumers saying, no, I don't want that penalty. It is not a penalty. It is a benefit to have private mortgage insurance in this current market due to the fact that the conventional loan that you have private mortgage insurance on is actually a little bit lower in interest rate because they protect the lender for the difference between 80% and the down payment that you're doing. So say you're doing an 80% loan, you're doing a 95% loan, and they protect that down to 80%, that extra 15%. So it has an insurance component. Luckily, PMI has now gone to tiered pricing. So if you have a great credit score, you're living in a good zip code, if you have two borrowers, you could have mortgage insurance as low as 0.17, just a little over an eighth of a point per month. It's so much lower. Now, there is a law that on private mortgage insurance, when your loan amortizes to 78% off of the original value when you purchased your property or refinance, it actually automatically removes from your loan. So all of a sudden you don't owe $80 more a month. It just goes away. So it's a real benefit to use private mortgage insurance at this time. And I highly recommend it. It's not a penalty. It's definitely a benefit to be able to have that.
And it gets you in the door.
Gets you in the door with as little as 3% down.
Interest rates. It's important in any market. We often hear about a rate lock or locking the interest rate. What is an interest rate lock? When does it happen?
For me, I always have the consumer decide when they want to lock their interest rate based on the timeline and closing of a purchase. So usually there's about a 7 to 10 day window. If they want to feel like they want to play the market, I'll send them market updates from all the experienced people in the know and tell them what they're forecasting for rates. But what is a lock? What that means is when you've found a property, identified a property, and you are ready to purchase and you're in contract, you have to commit to an interest rate. When you commit to that interest rate, that's the interest rate your note is going to be drawn off of. That's the interest rate you'll have for the term of your loan. But the market changes sometimes twice in a day. So monitoring that market when you lock in, you're going to be locked in for a time period. So let's just say you have 15 days remaining before you need to close. You can do a 15-day rate lock. If you have a 30-day, you can do a 30-day, 45, 60, 90, even up to 120 days to lock, usually on a construction loan at that point because they're trying to finish up the property. Rate locks often have a float down component. So if you lock in your rate and the rates drop dramatically in those 30 days, you usually can negotiate almost a current market to be able to get the benefit. But if you lock your rate for 30 days and the rates skyrocket, they don't come back to you at the bank and say, sorry, you have to have a higher rate. We are committed to closing at that rate, and you are committed to be able to deliver on that rate.
Fantastic. Please speak to seller contributions to help a seller.
Absolutely. Seller contributions to help get more buyers able to qualify for your home is definitely a great way for sellers and real estate agents to be able to help in a rising interest rate market. It just makes it more affordable for the consumers to have some of the costs associated with the loan covered without doing a huge price drop. It actually nets more to the seller and gives a bigger buyer pool as well.
Good point, because sellers often, 1/3 of the homes in America typically experience a price reduction before it sells. So rather than reducing the price 2% and 3% and 5% and finally sells, the seller could offer 3% toward seller contributions to lower the buyer's interest rate and closing costs and get that buyer in the door, and they have a home sale.
Absolutely. If you're looking at just an average, say $700,000 loan, which is the conforming top end limit, you're looking at a $700,000 loan and you're giving a contribution of $24,000. That $24,000 is a lot better than a $50,000 price reduction. And now you have a buyer who's going to save $1,000 to $1,200 a month by having their interest rate bought down. So it's a big impact. You can imagine having your savings of $1,000 a month. You're going to have more buyers who are going to be able to fit into that payment structure, especially if it's in a rising interest rate market.
Okay, that's an excellent point, because a lot of the agents, we typically have a rotation. 1/3 of the agents are rotating in, out, or stayed. So a lot of real estate agents working today have not been familiar with seller contributions and why it's important for the buyer to be involved with a transaction that has seller contributions rather than, I'd rather have that price lower, 25,000. Really? Are you sure? Isn't it better to have a lower interest rate for the first couple of years?
Absolutely. It's a benefit for both, especially in a rising interest rate market and having some payment shock for our consumers when they saw interest rates a lot lower at some point. And when they've been on the hunt for a year and a half and the market has changed, this gives them more opportunity, making it a buyer opportunity market because the sellers are willing to contribute to help close that purchase.
I've seen you many times on Zoom calls with real estate agents. We have spoken about this in the past with closing costs. So the seller is allowed to make a contribution for that buyer to pay for their closing costs, whether it's recurring, non-recurring, or both.
Absolutely. And one of the things I always train my real estate agents that I work with is make sure when you're asking for those contributions that you ask for all closing costs, not specifically non-recurring closing costs, because the recurring closing costs can be quite expensive in higher property value areas because that could be 6 months worth of your property taxes for their savings account to pay for their impounds and escrows. It also is that 1 year's worth of insurance so that they're ready and set up to go. Anything we can do to make the home more affordable for the buyer, especially in a rising interest rate market, is going to be better for the seller.
And that's what we call a win-win situation.
Absolutely.
Let's speak about the loan application process. How does one apply for a loan and how does it play out?
So there's a full process to getting a loan. Usually most lenders can approve you within 48 hours if they have all the documentation. One of the big issues that is facing us today is regarding credit reports. There is something known as a hard pull and there's something known as a soft pull. A hard pull on your credit report will actually impact your score going forward. So that's one of the things most consumers want to avoid. Not only will that happen, but on a hard pull, they will actually become a trigger lead. Trigger leads impact the buyers because they will be called by everybody who has purchased their data from the credit bureaus and be sold loans from them. This can be very confusing for the first-time home buyer. So a soft pull opts them out of that, or they can opt out themselves by doing the opt-out website.
Is the information now done online through a secure portal?
Yes, normally most lenders don't do paper and pen anymore. You're going to be working on a secure portal with a password and a logon, and that's where you're going to upload your documents so they're not just flying around on the internet somewhere. They'll be secure, they'll be available for underwriting. And these are important documents, things like W-2s, paycheck stubs, bank statements, things, tax returns, things you don't want somebody to be able to grab out of the ether.
Now, once it's in the banking system, so we have somebody like yourself, a loan originator who is dealing with the consumer. Behind you, you have a loan processor at the
Absolutely.
institution.
There's quite a few hands that touch a loan once it's been taken in. You'll have your loan originator. They will do all the functions that are required by their job to be able to disclose to you how the loan works, be able to show you what interest rates and costs are associated with that. And oftentimes the loan processor is the one who chases the paperwork for all those little things that come up because no
Sure.
two loans are alike, just like no two borrowers are alike. From there, it goes to the underwriter. The underwriter is the one who assesses the risk and makes sure that it fits the program and also looks to see if there may be a better option available for the consumer that makes it a little more affordable for them or mitigates risk. I was an underwriter for many years, and that's one of the reasons why I educate my consumers.
The best loan originators used to do underwriting. Let's talk about appraisals before you go, okay? Can you do that?
Sure, absolutely. I was an appraiser at one time.
One of my favorite topics is the appraisal of the property. Can you speak to appraisers and appraisals?
Absolutely. So, an appraisal is just an estimate of value in one day's time. It's just that day's value. And you have to understand it's a trailing indicator because they're looking at similar properties or comps that have closed recently in the area. And they're establishing the value for this particular property based on that information. The appraisers have to go through a lot of training. There is a lot of information on an appraisal. When I do a purchase or a refinance for a consumer, I always go through their appraisal and I highlight everything in there so they know everything about it. It's usually a comprehensive report, about 21 pages, and it will also show you a lot of things that are important. It'll also discover if there's any health or safety violations, things that could prevent this buyer from getting into the property and could cause issues for them. Those would be things like hole in the roof, hole in the floor, no handrails for over 3 steps, no smoke detector, no Theo monitor, those types of things they review to make sure that it's the safest place for somebody to be able to live in. But it is just one day's value. It is just subject to this appraiser's training and the market data. So yes, they're important, but they also have a range of value. It's not just one particular value. So you have to know there's some flexibility on appraisals.
Fantastic.
One of
Okay.
the things I look at when I'm reviewing appraisals is to make sure you have what's known as a bracketed value. When you look at the properties that are listed and what they closed for. So if you have a property that you're buying for $800,000 and the comparable sales or other properties that have sold were listed at 800 to 750 or 820 to 750. You want to see that yours was listed in the middle of there somewhere. It's bracketed on either side. After they make their adjustments for square footage, bedrooms, bathrooms, condition, you should be somewhere bracketed in the adjusted value as well. That's one of the things that I look at when I'm looking at an appraisal to see if this appraisal was done well. Now, the more unique the property, the harder it is to appraise. The more comps you have to have, but yet it's unique. So what ends up happening is you could have 7, 8, 9 comparables on an appraisal, and those additional comparables may only have one feature of the property. So let's just say you were doing a dome home or a prefab home that's shaped like a dome. There's not going to be that many of them. You may have one or two that are dome homes, and then you'll have other ones that are stick built or typical construction. You may have a modular thrown in, and they'll have components of the actual property in each one of them. And then they'll have to blend what the value is based on that. So the more unique the property, the more comps you need, which seems a little strange, but that's how it works.
Now, comps, short for comparables. Can you speak about comparables?
Absolutely. Yeah, comparables are basically similar properties that have sold within the last 6 months. Sometimes they may have to go back 2 years, depending if it's a unique property or not. And those properties are compared to our property based on square footage, bedroom, bathroom count, condition, land, any of those types of things that would impact them. And they may be different because really no two homes are alike. Even in your tract homes, you're going to have variations. So those types of properties are going to be looked at just the same way, but they're a little bit easier to get comparables if they were a tract by the same builder and they all sold.
All right, waiting for the piano to come in there. Now we have a home sale, of course, is going to need an earnest money deposit, a down payment, and a loan from the bank. How does that work with in terms of the timing to close escrow?
Great that you're asking that, Patrick, because a lot of my first time buyers don't understand the differences between those monies that are involved. And monies are the hardest thing in a purchase, believe it or not. That seems to be the hardest thing, at least in our market. So what you're looking at is typical to a market. They may have a 3% that you're required to put down or a 5% you're required to put down as your earnest money deposit. So let's just go out on a limb and say it's 10% that they require in this particular property for a down payment. If you put 10% down of your purchase price for your earnest money deposit, but you're doing a loan that only requires 5% down, the rest of the money will be used for any closing costs or any other fees, and you'll be refunded the difference. By the same token, if you have an earnest money deposit of 3% and you're going to be putting 10% down, you're going to have to come in with that additional 7% at closing plus closing costs. And then the loan will cover the rest of it for your 100%.
Now, that loan is generated by the lending institution and they wire the money to the neutral third party, the escrow officer.
Yes, escrow and title are very important.
Can you speak about the difference?
Absolutely. Oftentimes in parts of the country, they may not use escrow. They may use lawyers and they'll use title insurance, especially if you're going on the East Coast. In Southern California, title and escrow are two different things. And oftentimes in Northern California, as with other states, you're going to have title and escrow as one company, and they do both. Title is the portion that makes sure that you own your property cleanly. They ensure that property is owned by you when you purchase, and it has no past items that are going to be coming back to get you. It's very important. This is a huge investment. So title insurance does that portion as well as ensures the lender's interest on the property as well. Escrow is the one that actually holds the funds. They're a neutral third party who helps manage all of the parties. They manage the selling agent, the buying agent, the borrower or buyer, and the seller. And they are a neutral third party who holds the funds. So they're your protection to make sure somebody doesn't run away with your money. And they make sure everything goes hand in hand with title so that you get your perfected title or your home.
Well said. Talk about gift money real quick before you go.
Sure.
What I'd like you to introduce here is the additional sources for a down payment. It could be the sale of a condo back east or money overseas, a gift money from a rich uncle. What are you seeing and how does that play out with the sale of the home during escrow?
One of the tightest things when you're buying a home is your down payment and your closing. So a gift in a conventional loan is considered your money. So you don't have to have a minimum of your own funds put in. So that's a change to the guidelines. So if you're doing a 5% down purchase or a 95% loan, you can actually have all 5% gifted from a family. Depending on government or if you're doing a loan that's conventional, they have certain relationship requirements that are involved. So ask specifically on those, as well as the fact that I often see people borrowing from their 401k to do a purchase. And that's really investing your money in your down payment. It's a great way to be able to pay yourself back. And it's also a great way to build equity and wealth. So oftentimes the 401k is borrowed against for $50,000, and that money is used for your down payment and any closing involved on your transaction. Now, the nice thing about it, you're borrowing from yourself. You're paying yourself back through your regular 401k portion. So it's a great way to put your money to work before you retire and build some equity at the same time.
What about overseas money?
You
From a
have to be
relative?
very careful when you have overseas money. A title has some specific documentation regarding certain places they cannot receive funds from. So, in particular, if you have money that's coming from outside the country, you're going to need to check with your lender to see what type of restrictions they may have. It's oftentimes difficult to document. Imagine getting a source of where that money is coming from, but it's coming in a foreign language. So getting translated documents is often involved. It is very common to be able to get gifted funds from out of the country.
Oh, this is one of my favorite questions. Have you noticed property sales slowing down due to the condition of a property?
In the current market, we really aren't seeing a lot of issues with that because they're getting full inspections and they're clearing them before they sell. But in the event that they do have some deferred maintenance on properties, then you can actually sell it as long as it doesn't have an impact on value and isn't reflected in the appraisal as a health and safety issue. In reference to doing a VA or a Veterans Home Loan Benefit Loan, they are required to clear Section 1 of your termite report. Conventional does not require termite report or clearance. Neither does FHA. That's a change because they are governed by HUD. We do not require that either. Now, if there is a request on the purchase contract for a termite report and clearance, then the lender is going to want to see it and make sure that all of the work is completed. So make sure that when you're working with your buyers and your sellers and the real estate agents, that if that is not something you want to have included on your property and you've negotiated that, then you don't provide that information and you don't require it on the contract. We will follow the contract. If the contract says work's going to be done, we want it done as a lender prior to close.
Understood.
You were asking earlier about delays in the supply chain and how it might impact properties to get completed for some repairs. There is the ability to do what's known as an escrow holdback. Let's just say that tile's back ordered and we're not going to get that flooring in until 2 weeks after they take possession of the property. That's okay. The title company will hold 1.5 times of that cost, and that will just be paid out as soon as it's done. The mortgage goes through, the home ownership goes through, and then title does that disbursement when the property is finished. So it's a good way to protect everybody and not lose that rate lock and not lose that transaction and all of those good things and still be able to close on time. One of the topics that seems to be a real hot one right now is because mobile homes and parks and how difficult it is to be able to have them affordable. That's one of the topics I talk to real estate agents about all the time.
Is it space rent?
Yes. And it's an important topic. And here's how I look at it. Mobile homes sound like an affordable option, and each city charter actually has a requirement for mobile home lending. They must be able to have a certain amount of mobile home space in each one of the charters. So because they have that for each city, it's supposed to be entry and exit level housing, meaning when you're retiring and when you're just starting a family. So it's for both sides. But due to the fact that these mobile homes are fairly well priced, one of the things that's a little frustrating with mobile homes is they're supposed to be affordable housing for entry and exit level housing, meaning when you're first starting that family and when you're downsizing and getting your retirement. Unfortunately, the space rents on these mobile homes in parks have become so expensive that it makes it difficult for people to qualify. I want to make sure that you understand that it's not the lender who is having the issue with it. It's really the park. And here's why. Some of these parks space rent can be as much as $1,000. Let's just pick a number. It's a lot of money. The buyer must qualify with any mortgage payment plus this space rent and have 3 times that in their income. Often a retired couple will not have that. Often a couple who's just starting out will not have that type of monthly income. It's often easier to qualify for a condominium than it is for a mobile home.
Oh, that says it all right there.
Absolutely. Now, manufactured homes is a whole nother story.
Yes.
Manufactured home, if you own the land it's on, is actually treated just like a stick-built construction. You have some requirements, but it's a good way if you had land and you had a foundation. You can do a loan to put the mobile on and hook it up to city sewer and water or well and septic and have a perfectly great property and not have some of the construction costs that can be very expensive when any supply chain issues happen.
Is the lending different for a mobile home versus a modular home as opposed to a single family residence?
Some financing is different. So there are specific requirements for a mobile home that have to be met. It has to be 1976 or newer. It has to have a HUD series number underneath the sink in the kitchen.
What does HUD stand for?
Housing and urban development, meaning
Okay.
it meets housing standards. A
Got it.
lot of the mobile homes prior to 1976 didn't have escape windows if there was a fire, didn't have the ability to have the sound deadening, didn't have a lot of the things that we require to have safe housing. That in itself is not the biggest problem, though. The biggest issue is if it's in a park, it makes it difficult to lend in, and there's a larger down payment, and it's considered a consumer loan. If you have it attached to real property in a place where you own the land, then it is now real estate. So those are the two issues. You're either doing a consumer loan in a park or you're doing a real estate loan on land that you own.
All right.
It's nationwide.
Oh, okay. Thank you for listening. This is Pat Kapowicz, broker number 00979413. You're listening to Housing Issues with Pat. We had a wonderful guest today. TJ, thanks again for coming out.
It was my pleasure, Pat. Thank you so much. TJ Roberts, MLO 1457455. Thank you for joining us.
Remember to check out the links in the description and other Kapowicz resources. For those of you interested in amplifying the quality of your housing sales, be sure to check out my other interviews with housing experts on Housing Issues with Pat. Until then, take good care.